Well, the U.S. Treasury market is seeing a significant dysfunction trend, with the holdings of primary dealers surging to a new record. This comes when the central bank is decreasing its balance sheet and the demand has fallen for U.S. Treasuries. In this next report, we decode that trend. Take a look. Asian stocks edged higher on Monday after data showed U.S. inflation was fairly mild at the start of the year. A lower reading defied concerns for a bigger jump and boosted expectations that the Federal Reserve will deliver more interest rate cuts this year. Barring a 6.5% jump in airfares, U.S. inflation pressures look remarkably benign, with core goods prices not changing on the month. Tariff costs continuing to be absorbed by corporates. The consumer price index rose 0.2% in January, the smallest gain since July, and restrained by lower energy costs and underlying metric known as the core CPI, which excludes food and energy, advanced as expected from a month earlier. The latest data defies a broader trend in recent years. January inflation readings have been strong in recent years, often beating expectations as companies tend to raise their prices at the start of the year. Many economists had called for an even bigger pickup in the core CPI for that reason. They had also predicted that firms would pass along more tariff-related costs to consumers. That said, import prices aren't falling and corporates are still paying billions more in tariffs each month versus 12 months ago. So analysts are reluctant to rule out some lingering price pressures. Markets have reacted dovishly, with Fed rate cuts now priced in to come in earlier than previously thought. Investors continue to bet on 2 cuts this year, but they say the Fed is likely to be more aggressive given the cooling jobs story and increasingly benign inflation backdrop.